Have you ever felt like figuring out a stock's real value is, well, some kind of dark art? A mix of pure guesswork and maybe a little bit of blind faith? Well, today we're going to pull that curtain all the way back. We're turning that guessing game into a clear, systematic process that'll help you look at any company with the confidence of a pro. I bet you've heard this a million times, right? You see it in group chats, on TV, everywhere. Somebody just throws out a number, like a PE ratio, and declares a stock cheap or expensive. It sounds so definitive, so smart. But here's the thing, real valuation is so much more than that. It's definitely an art, I'll give you that, but it's an art that's built on logic and a structured approach. And today, we're going to learn exactly how the professionals build their case for what a company is truly worth. All right, let's dive right into this first big idea. Before you even think about hitting that buy or sell button, the whole point of valuation is just to figure out the approximate worth of the business you're studying. And this brings us to a fascinating paradox. You see, there's no single, universal, correct price tag for a company. It's subjective. Its worth really is in the eyes of the beholder. And because it's subjective, we desperately need a solid framework to guide us to a logical answer. Otherwise, it's just chaos. So how do we build that framework? Well, it all comes down to what our source calls the 3 pillars of valuation. I want you to think of these as your foundational toolkit. Pretty much every professional valuation method out there is just a variation of one of these 3 core ideas. Okay, pillar number 1, relative valuation. This is the comparison method. It's pretty simple in theory. You're just looking at what similar companies, what we call peers, are worth in the market right now to get a feel for what your target company should be worth. The basic question this whole method asks is, what are its neighbors worth? So if a company's main competitors are all trading for about, say, 20 times their earnings, that gives you a really powerful starting point for what your company's value might be. Now, the key here is knowing its strengths and weaknesses. This method is amazing for quick checks in stable industries where you have a bunch of clear competitors. But, and this is a big but, it assumes the market is being rational. If the whole industry is caught up in a bubble and everything's overpriced, this method will just tell you your stock is, well, also overpriced. It doesn't tell you if the whole playground is on a cliff's edge. Let's move on to our second pillar, asset-based valuation. This one takes a completely different angle. For a minute, let's just forget what the market is shouting about. This is the net worth method. We're getting our hands dirty and looking at the actual, tangible stuff the company owns. It answers a really practical question. If you had to sell off the company tomorrow, liquidate everything, sell the buildings, the inventory, the land, and then use that cash to pay off every single debt, what would you have left? That leftover pile of cash is its net asset value. This is the perfect tool for businesses that are all about physical stuff, like real estate firms or mining companies. But what about a software company or a brand like Coca-Cola? Their value isn't in their factories, it's in their code and their brand name. This method completely misses that. It just can't value the things you can't touch. And that brings us to our third and most forward-looking pillar, the income-based approach. This one doesn't care about the past, or even really the present. It is all about the future, specifically a company's potential to generate cash. This is where the famous or infamous discounted cash flow, or DCF method, lives. The question it's trying to answer is really the million-dollar question in all of investing. How much cash is this business going to spin off for the rest of its life? And more importantly, what is all of that future cash worth to me, right here, today? So this method is incredibly powerful, especially for those high-growth companies where the whole story is about future profits. But it's also the most dangerous. Your entire valuation hinges on the assumptions you make about the future, and a tiny little tweak to one of those assumptions can cause a massive swing in the final value. It's a real high-wire act. Okay, so we've got our 3 pillars: comparing to others, adding up the assets, and predicting the future income. The real skill of a great analyst isn't just knowing the methods, it's knowing which tool to pull out of the toolbox for which specific job. It's all about matching the method to the business. You see a mature IT company with lots of stable competitors, you're going to use relative valuation. A real estate company, you look at its assets, its land. That high-growth startup that isn't even profitable yet,
Well, you have no choice but to try and forecast its future income. As you can see, there's absolutely no one-size-fits-all answer here.
Now, let's have a quick reality check. For most of us, trying to build a super detailed long-term income model is, well, it's really, really hard. I mean, CEOs who run these companies struggle to predict next quarter's earnings, let alone the next 10 years. So the smartest, most effective path for most people is to get really, really good at that first pillar, relative valuation. All right, so you've got the tools, you know how to pick the right one for the job, but even the best carpenters can hit their thumb with a hammer. Let's quickly run through the most common traps investors fall into so you know exactly what to watch out for. And here they are, the classic mistakes. The biggest trap of all is just fixation. Getting fixated on one number, one method, or, this is a big one, on this idea of false precision, trying to value a company down to the exact penny. It's impossible. Context is everything. A pro avoids these traps by using multiple methods. They triangulate. They build a story from different angles to come to a much more logical conclusion. Okay, so let's put everything we've talked about together into a practical 5-step framework that you can start using on your very next idea. Here is your game plan. First, classify the business. That tells you what your main tool should be. Second, gather your data. Find 3 to 5 true competitors. Third, and this is super important, apply at least 2 methods. Triangulate your value. Fourth, the sanity check. Just step back for a second and ask, does this number even make sense in the real world? And finally, step 5, the golden rule. Build in a margin of safety. You do all this work to find what you think the company is worth, and then you insist on buying it for less. That's your cushion. That's your protection in case you're wrong. And that really brings us to the most important takeaway of all. The science is what we've talked about, the 3 pillars, the frameworks, the calculations, but the art is in the judgment you bring to the table. It's in how you pick the right peers, how you make reasonable assumptions, and how you understand the story behind the numbers. Mastering both of those, the art and the science, that's the real path to becoming a thoughtful, effective investor. The only question left is, are you ready to start painting?